Hey guys, welcome back to the channel. Thanks for stopping by and checking out another video with us. And thank you for being a subscriber. I'm Tom Boland, and in this video, we're going to be talking about cash flow and capital growth and the differences between the two. Now, there are a lot of people out there that have opinions where they want to invest for cash flow, and there's others that have the opinion where they want to invest for capital growth. And then there's some on the fence who don't have a preference for either cash flow or capital growth. They like a bit of both, or sometimes a lot of both. So in this video, we're going to explain what the two differences are and how they can benefit you. So cash flow, what is it? Well, let's say you've got a job and you're earning a salary of £2,000 a month. That is essentially your cash flow. Now you've got your gross cash flow and your net cash flow. So the gross is everything that you bring in every single month or every year. And then the net is everything that you actually get to keep after your expenses. So when you look at a business, or in this case, I'm a property investor, so I treat my property investments as a business. We have a gross cash flow coming in from our rental income. And then we have things like insurance, letting agents fees, any maintenance or upkeep of the properties, voids, council tax, all those kind of costs to cover. Once all those expenses come off, our gross cash flow, then we're left with a net cash flow. And the idea is that your net cash flow wants to be a positive rather than a minus, month on month, and then year on year. And therefore, over the period of time where you're having a strong cash flow, you can begin to live off that and take a dividend or a salary and pay yourself from your cash flow. And in some instances, it can replace your income from a salary paid job. Now, that is basically cash flow in a nutshell. Capital growth, what is that? Well, capital growth and appreciation is something where the value goes up over a period of time. And again, in this instance, we'll talk about property because I invest in property, and I'm sure most of my viewers are interested in property investing. So let's say this property that we buy for £100,000 within that 5-year period goes up by 10%. So it's increased in value by £10,000. What happens after that 5-year period? Well, in property, especially, we can leverage that £10,000 increase in value, and we actually call it equity. It's created equity within that property, and we can release that equity within that property. So we can go and finance the property against the increased value of £110,000 and release that £10,000 worth of equity. So that is basically how capital growth works, where over a period of time, the value of something increases, and that is down to inflation and other factors where things do go up in value or go up in the asking price. So you think of like the chocolate bars like Freddo's, when I was younger, they were like 10p and now they're selling for like 50p. And that's down to inflation. So we can take that idea and implement it within our businesses and our property investing and know that we're going to sit on a property over a period of time. It's going to go up in value. Very rarely the property values drop. And if they do drop over an extended period of time, they will increase in value. Now think about it. Which one would you prefer? Would you prefer maybe £2,000 in net cash flow a month, every month? Or would you prefer capital appreciation, capital growth? Now, I like a combination of both because it's great to have that cash flow month on month to cover living expenses, pay for the car, pay for the mortgage, the food, maybe use it to go on holidays. But cash flow doesn't create wealth. Now, of course, if you're having cash flow of maybe, let's say 50 or 100 grand a month, it's very good cash flow. You're not going to be spending that every single month, although you could. But if you live frugally, then you don't have to spend that amount of cash flow every month, and you can save that, and then that should be able to create wealth, although it depreciates if you don't invest it over time. However, capital appreciation, because you have assets that are appreciating over time, year on year on year, and you have equity that's creating wealth over that period of time. Once you release that equity, you can have that lump sum of cash, sometimes tax-free, to create overall wealth. The equity, if you do not touch it within your portfolio, therefore creates even more wealth that you haven't actually touched yet. And if you do want to liquidate that equity and that wealth in 20, 30, 40 years' time, now that is when you become very, very wealthy. If you take your cash flow and instead of spending your cash flow, reinvest it, as well as using your capital appreciation or your equity within your portfolio, combine the two figures and reinvest them year on year on year over a 5, 10, 15, 20-year period, And imagine doing that when you're 20, 30, 40. When you're 40, 50, 60, you've created an amazing amount of wealth. So that is why I like both cash flow and capital growth. So think about that, guys. I hope you take something out of that video. What do you like? Please leave it down in the comments. Do you invest for cash flow? Do you invest for capital growth? Do you invest for both? Maybe you're investing for cash flow now because it helps you take a step back from your salaried jobs and helps you cover living expenses, therefore frees up your time to create wealth. There we go, guys. Thank you very much. Appreciate you for stopping by. Appreciate you for being a subscriber. I'll see you on the next one.